Hi there and welcome to GrainTV. It's Thursday, October 8th, one day before the USDA releases their latest supply and demand report. The markets took a day to sell off with corn down 4, beans down a dime, and wheat in Chicago off 6 cents. Let's take a look at some of the major news that was out this morning. And first to start was the announcement of USDA's weekly export sales report. This came in as a mixed bag. Corn coming in on the low side of expectations, 519,000 metric tons for the week. This was below trade analyst expectations of 550 to 750,000 metric tons. Beans coming in just above expectations at the high side with 1.28 million metric tons. This is off from last week's 2.5 million metric tons, but still an impressive number. And not accounted for in this is another almost million metric tons that was sold for the new crop of 2016. So yet again, another good week for beans in terms of export sales. Wheat came in on par with analyst expectations at 288,000 metric tons. This is up sharply from last week's abysmal 70,000 metric tons, but still nothing to get excited about in terms of analysts' expectations. We're just not seeing the business that we need to see in wheat to get the market real excited. I guess in wheat, the good news that is coming out is there is a fair amount of tender activity business. Saudi Arabia announced a tender. A few other countries announced smaller tenders. So there is some business starting to pick up in the international marketplace, and it'll be interesting to see if the U.S. can garner any of that attention. But really, the trade is focused on what tomorrow is going to bring for USDA. That report is going to be released at 11 o'clock Central Time during trading. So you want to make sure and see what those numbers come out to be in terms of USDA. Analysts going into this report just don't look for much of a change in terms of supply numbers. They're looking for a slight drop, not only in corn, but in bean production as well. These are not dramatic changes in line with what USDA said in September. So it's going to be interesting to see if we do get a big change in production, either to the upside from September or to the downside, because analysts aren't looking for much on average. So right now we'll see if trade responds accordingly with a big supply change, if that does in fact occur. On ending stocks, again, not much to write home about in terms of analyst expectations, just a slight drop in corn ending stocks and a slight drop in soybean ending stocks from where we were in September based on that lower production. If I'm a producer, the one thing that's making me a little nervous, not only with the supply numbers that are out there, but sort of the really disappointing pace we're seeing for corn export business. You know, so far year to date, we are substantially below where we were this time last year. If we look at our export sales cumulative chart, this shows for the week of the 5th week of the marketing year where we stand in terms of total cumulative exports. We are only at 11 million metric tons. This time last year, we were at 15 million metric tons. So that's a huge drop. And if you look at that green line, that pace line, based on what we should be achieving based on USDA's annual forecast, we should be around 16. So no matter how you slice it, we are behind pace, we are behind par in terms of reaching USDA's current export target for the year. So that leaves me a little concerned that at some point, if we don't start to pick up the pace, USDA is going to have to trim that number, which will obviously inflate ending stocks. You know, whether that'll happen in the October report, I don't know, but it is a potential wild card down the road. The good news is on soybeans, we've had really good export sales here in the last few weeks. We've caught up to that pace line. We are factoring in already a lower export number for the year compared to last year in blue. And so we're on pace to reach that lowered export estimate. So that's a good sign. We're not at the pace where we were last year. But the fact that we've had good business here in the last few weeks and got caught up to that pace is somewhat encouraging for soybeans. So keep in mind that report's coming out at 11 a.m. tomorrow. You know, for you producers out there that are worried about that report and how you can sort of protect yourself against that potential news event, you know, one of the things we've been talking about with clients is using short-dated options as a intermediate term price protection, whether it's buying calls or buying puts, to cover any sort of positions you may have. So if you're worried about the potential ramifications of this report tomorrow, getting into a short-dated option right now, October 23rd expiration of those DEES calls or DEES puts, those are trading at substantial discounts to the traditional or normal December options that expire on November 20th. So if we're looking, for example, for a $4 call, the premium on that is 5.5 cents based on the close today, versus a longer, more normal option that expires on November 20th, which is 9 3/4. And then likewise on the put, you're looking at 4.25 premium on a 380 put that expires October 23rd versus the 8.5 cents on a November 20 expiration. So the benefit of this is it costs you less out of pocket. It protects you for the next few weeks, and particularly around this report event that's coming out tomorrow. So for producers that are looking to cover some positions or protect some risk, maybe consider those short-dated options. By all means, give us a call at Grain Hedge, 877-472-4607 if you have a question or need help executing a trade in that fashion.